In a matter of minutes, Tesla's stock plunged over 9%, catching even seasoned investors off guard and sending a ripple of anxiety through the financial markets. The sharp drop came right after Tesla released its Q2 2025 earnings report, which fell short of Wall Street's high expectations and immediately triggered a wave of sell orders. In the blink of an eye, billions of dollars in market value vanished, leaving investors reeling and financial news outlets buzzing with urgent updates about the sudden downturn. But this wasn't just about one disappointing quarter. The earnings miss exposed deeper concerns: slowing demand for electric vehicles, intensifying competition from both established automakers and new startups, and broader economic headwinds that are making consumers more cautious. For a company that has always been seen as a symbol of relentless innovation and growth, a year-over-year revenue decline and missed profit targets sent a clear warning sign to the market. Investors, driven by a mix of hard data and raw emotion, reacted almost instantly. Many began to question whether this was just a temporary setback for Tesla, or if it pointed to more serious, long-term challenges ahead. The real question now is whether these are simply short-term hiccups that Tesla can overcome, or if the company's legendary growth story is fundamentally changing in the face of new realities. To understand what's really going on, let's take a closer look at the numbers and the factors driving this dramatic shift in Tesla's fortunes. Tesla's Q2 2025 revenue came in at $22.5 billion, an impressive number at first glance, but it still fell short of Wall Street's expectations, surprising many analysts who had predicted stronger growth. The figure also marked a 12% decline compared to the same quarter last year, highlighting a concerning slowdown for the electric vehicle giant. Profits missed the mark as well. Earnings per share landed at $0.40, just under the $0.42 analysts had hoped for, signaling that Tesla's profitability is under pressure. Operating income was another sore spot, falling short by over $300 million, which points to rising costs and shrinking efficiency across Tesla's operations. The real blow, however, came from vehicle deliveries. Tesla delivered just 384,122 units, a sharp 13.5% drop year over year. This decline was driven by both planned factory downtime and a noticeable dip in consumer demand, with fewer cars leaving the factory floor and more unsold vehicles piling up. The company faced tighter profit margins and less revenue to work with, making it harder to maintain its industry-leading edge. Another setback came from regulatory credits, once a reliable, high-margin revenue stream for Tesla. This quarter, those revenues plunged by half as competitors ramped up their own electric vehicle offerings and caught up on emissions targets. Tesla has warned that this income will likely keep shrinking in the coming quarters, putting even more pressure on its core business to deliver results and innovate. The result, a financial report that rattled even the most optimistic investors, raising tough questions about Tesla's growth trajectory and future profitability. The market's reaction was swift and brutal, with Tesla shares tumbling as investors digested the disappointing news and recalibrated their expectations for the company's future. The $7,500 federal EV tax credit, a key driver of Tesla's U.S. sales, is ending after Q3 2025. This looming deadline pulled future demand into the present, as buyers rushed to lock in the discount. Now, with the credit gone, Tesla faces a demand air pocket, a sharp drop in new orders. The company warned of limited supply and urged buyers to act fast, underscoring the challenge ahead. Without the subsidy, Tesla must prove its cars are worth full price as competition heats up, especially from affordable hybrids. As the market leader, Tesla is most exposed to this shift. The pressure is on to justify its premium and keep innovating. Elon Musk didn't sugarcoat it. Tesla could face a few rough quarters. The end of the tax credit, rising competition, and shifting consumer preferences all spell turbulence ahead. Weakening demand in the US, Europe, and China means Tesla can't rely on overseas growth to offset domestic slowdowns. Musk's message: brace for a tough transition, but stay focused on the long game. By setting expectations low, he's aiming to build credibility and buy time for Tesla's next act. Investors are being asked for patience as the company navigates this storm. Despite some short-term pain and recent challenges, Tesla's future is all about relentless innovation and bold ambition. The company is doubling down on its mission to accelerate the world's transition to sustainable energy, and it's not slowing down. The first builds of a new, more affordable model began in June 2025, marking a major milestone for Tesla. Volume production is set for later in the year, with the company aiming to ramp up output quickly to meet global demand and bring electric vehicles to a much wider audience. This car is designed to crack the mass market, making EVs accessible to millions of people who previously couldn't afford them. By lowering the price barrier, Tesla hopes to spark a new wave of adoption and fundamentally change how people get around cities and suburbs. But Tesla's vision goes far beyond just selling cars. The company is betting big on autonomy, with its purpose-built robotaxi on track for a 2026 launch. Real-world testing is already underway, and Tesla is pushing the boundaries of what's possible with self-driving technology. Elon Musk claims the robotaxi network could reach half the US by the end of 2026, a bold vision that, if realized, could transform urban mobility and create a new era of transportation. These moves signal a dramatic shift for Tesla, from being just a car maker to becoming a true tech and AI powerhouse. The company is investing heavily in artificial intelligence, software, and data, aiming to lead the next generation of mobility. If Tesla succeeds, recurring revenue from autonomy and digital services could eventually dwarf traditional car sales, creating a powerful new business model with long-term growth potential. This is the story long-term investors are being asked to believe in, a future where Tesla is not just an automaker, but a leader in technology, autonomy, and sustainable innovation. After the stock's plunge, analysts are split. Is Tesla a bargain or a falling knife? Bears see a company facing real threats, shrinking margins, missed deliveries, and the end of subsidies. Bulls argue the market is too focused on short-term pain, ignoring game-changing catalysts like autonomy and next-gen EVs. Tesla is transitioning from premium EVs to real-world AI and higher-margin products. Judging Tesla only by quarterly car sales misses the bigger picture. The analyst community offers no easy answers, just two competing visions of the future. For investors, it's all about time horizon and belief in Tesla's ability to execute. So, is now the time to buy Tesla? It depends on your risk tolerance and faith in the company's vision. Short term, the outlook is rocky. Volatility and more disappointments are likely. But for long-term believers, this could be a rare buying opportunity. The stock is being punished for near-term issues, while Tesla's most ambitious projects are closer than ever. Betting on Tesla now means accepting big risks, competition, regulation, and execution challenges. But it's also a bet on world-changing innovation, affordable EVs, full autonomy, and a new era of transportation. If you believe in that story, today's crash might be tomorrow's opportunity. For patient investors, this could be the moment to act. Remember to like the video and subscribe to the channel for more videos like this.